up 1%.
Nifty needs to close above 25,116. Nifty Bank is up, of course, at 300 points.
Demand is far outperforming compared to the supply.
The amount of gold we have with us and the amount of loan we accrued, it is only 58%.
And it's a solid start to the trading week. The Sensex is ahead by close to about 400 points.
SPX is the dominant player as far as the spot market or the short-term power market is concerned.
DFS has acknowledged the importance of bank assurance when it comes to distribution of insurance products. Individual agents will be allowed to only tie up with one life, one general and one health insurance company.
The maximum LTV will be capped at 85% for gold loans of up to 2.5 lakh rupees.
The bulls have taken control. We have extended gains as compared to what we'd seen on Friday.
Okay, pretty settled markets. It's not wild west if you were hoping for that kind of a day. It's day two in terms of RBI reaction. Financials very much top of mind, but that doesn't mean that, the element of surprise, of course, all kind of got done on Friday. Today, it's just extensions. That's going to be the talking point here over the next hour or so. This is Closing Bell. We are coming to you from the CNBC-TV18 News studios. I'm Prashant. Reema and Surabhi here in the studios, and Nigel is joining us from the newsroom floor. Guys, good afternoon.
Good afternoon, but as they say, one step at a time, steady as she goes, and I guess that's been the shape of the market. Not too bad. We put on another 100 points on the board, and very much right there at the top of the recent trading range.
Well, that's right. I think we couldn't hold on to the starting gains, but par for the course, right? Breadth of the market still good, 3-1. Well, you'll take it after the monster rally that we saw on Friday. Still holding in the green itself is an achievement, I'm guessing.
Absolutely, and I think the 25,116 level, we've basically stayed under. It's not. I mean, basically, it's just the swing high. 25,116 is the top end of that range. And only two times around 11 o'clock, there was a bit of a pop. We took that out. Of course, open, and then the 11 o'clock and 12:30. Otherwise, we've basically spent the day under it through the course of the day. The bigger question, which I asked in the morning also, which I guess will be wiser in hindsight, is will we follow, what we saw post-budget when names like Lever, etc., pop 10-12% quickly in 2 days, only to kind of fizzle out over the next 10 trading sessions or so. This is more durable with what we're seeing with many of these, especially the NBFCs, second-tier banks, financials broadly. On the Nifty Bank as well, if you look at it, it's a bit of a red candle, but then the market's basically trading below where it opened. So same is the case with the Nifty as well. So lots to talk about as far as individual names go. Reema.
Indeed, it's NBFCs and the PSU banks. The Nifty PSU banking index is up 1.6%. And look at the way some of these financials move. Bandhan Bank, 7.5%. There are only buyers right now on Bandhan Bank. RBI Bank, 5.5% up. South Indian Bank, up and about. You've got Manappuram General Finance surging in trade. Many capital market plays. If you look at it, the Nifty Capital Market Index, that's the best sectoral gainer today. And names like JM Financial, Edelweiss Financial have a gain of close to about 7.5%. On the way down, I think it's Swiggy and Eternal, which deserve mention, and both of them have lost 2.5% following Rapido's entry into the food delivery market. So competition rising in this segment.
And that's always a specter, right? I mean, for whether it's quick commerce or it's food delivery, that's always the issue. Who is going to be the next entrant and with how deep a pocket to really disrupt the game? And we'll talk about this with our experts as we go on. But the broader screen is really where the happiness seems to be today. Once again, the Midcap index is up about 1%. Remember, in between these indices, the Midcap index is barely 2% away from its all-time high. Small-cap index is still a distance, 4.5% away. Midcap index, practically there, and it's been a good day. You look at names from financials. You even have something like an Edelweiss Finance doing very well today. 7.5% on Edelweiss. There is Dilip Buildcon, Shakti Pumps. There's, of course, IIFL Finance, JM Finance. So lots and lots of names on the upside. MCX we've been discussing, of course, since the morning because they are now launching electricity futures or electricity derivatives, really. Futures will be a part of it. But many names. And I should also mention here Westlife. Westlife had a good session. Last I saw it was up 6.5%. So some of these niche mid and small cap plays, they're definitely finding takers in the... Wow, look at that, 12%. Burgers are flying off the you know, what should I say, frying pan maybe. What a move on this one, Nigel.
I'm ready with my plate, Surabhi. Where's the burger?
Dialing. We'll share.
Where's the burger? Mangalam also 12 o'clock. He's saying the stock is flying away. Nothing came from him. He finished jubilant food.
It's Monday. We have to be disciplined. No. Only salad. Sorry, let's go on.
All right, let's get in. Let's get in Mitesh Thakkar. Mitesh, what's flying away today are the mid caps. You know, mid and small caps are doing relatively better. And, you know, not the larger banks, actually the smaller ones are really bucking the trend. What's your view on the Nifty itself? We're still not able to take out the morning high. Even on the Nifty Bank, it seems, you know, par for the course, but that 57,000 mark, which we conquered in the morning, we're not been able to get past that. So your view on the headline index, and then you can help us out with your picks.
Well, good afternoon, Nigel. I think, you know, to me, it looks like a good market. Yes, there has been some kind of a pause if you look at just the intraday action. But also what is good is that we had a gap up and neither of the indices have tried to fill that gap. I think that's sustaining and we are now nearly in the last hour of the trade. So to me, it's a positive sign. I believe that if not today, in the next few days, we should head higher and the Bank Nifty not only should capture 57,000 but head towards 57,500, even 57,800. Similarly, the Nifty could head towards 25,400, 500. So positive there. On the stock side, I have a buy on Indigo, that's Integral Aviation. Keep a stop below 5,600, look for targets of 5,800. And Axis Bank is another one which I like a lot. That's a stock which I recommend buying. Keep a stop just below levels of around 12.05 and look for targets of around 12.55.
Got that. Let's talk about some big movers today. Gold financiers are firing away in trade on the back of RBI's relaxations on gold loan norms. Ritu is joining in with the details and how it impacts individual players.
Well, the Reserve Bank of India's new gold loan rules have eased some of the tighter norms that were proposed in the earlier draft, specifically to ease credit access for the smaller borrowers. Now, the final rules have specified a tiered structure for the loan-to-value or LTV cap for consumption gold loans versus the flat 75% which was proposed earlier. So now, the maximum LTV will be capped at 85% for gold loans of up to 2.5 lakh rupees, at 80% for loans between 2.5 to 5 lakhs, and 75% for loans of more than 5 lakh rupees. However, as was proposed in the draft, the LTV will have to be maintained throughout the tenor of the loan, and for bullet repayment loans, the LTV will be calculated on the total amount that is repayable at maturity, including the principal and interest. Now, this simply put means that if the gold collateral is valued at 1 lakh rupees, lenders can extend loans of up to 85,000 rupees including interest versus 75,000 only earlier in the case of small loans, for example. Now, to simplify things further for the smallest borrowers, loans of up to 2.5 lakh rupees will also be exempted from detailed credit assessment. Now, apart from this, RBI has reiterated some of the rules that were proposed in the draft, like loan renewals and top-ups can only be allowed for standard loans, and after repayment of the accrued interest, there will also be a 12-month tenor cap for bullet gold loans, and multiple loans to a single borrower are going to be subject to stricter audit and so on. Now, Morgan Stanley says the final rules are more relaxed, and it has an equal weight call on Muthoot and Manappuram, overweight on Shriram Finance and Bajaj Finance, and says Muthoot has potential for more upside. Jeffrey says the rules ease concerns on growth and cost pressures, and its top pick is also Muthoot.
Okay, all right, Ritu, thanks very much. Yes, absolutely. We heard the governor say that, and the final norms came in. And thank you for the brokerage views as well. And most of these stocks have done not just very well today, but even otherwise. Let's pull up slightly longer-term charts, if we can, of both Manappuram and Muthoot. If we look at Muthoot is up about 14% this month. And this calendar year, which has been a challenging calendar year for Indian equities, Muthoot has done about 19%, so it's not bad at all. Manappuram this year is up 38% already. I mean, that is just 2025 I'm talking about. So it's been a phenomenal move. And of course, 12 months looks even better on these stocks. The question is the best already in the price, or should you still buy? Well, let's ask Deepan Mehta, Director at Elixir Equities. Deepan, great to have you on as always. Good afternoon to you. So that's the question. These gold financiers, does the going get even better, or is it, much of this excitement is already being captured in current prices?
Good afternoon, Surabhi, and thank you for having me on your show. No, I think that the momentum can take gold loan companies even higher. And although there's a lot of competition coming in from banks and new entrants, I think the two big stalwarts, that is Manappuram and Muthoot, although they have lost market share, But still, I think they are still able to get the growth rates going for themselves. Would prefer Muthoot over Manappuram because Manappuram's foray into non-gold business has not been that successful. Especially the microfinance has been a bit problematic. But Muthoot has stuck to its knitting and they are focused only on gold loans and gradually expanded over there also. And even in tough times, they did very well. So I would remain invested in Muthoot Finance, maybe buy further at corrections. Having said that, it's a company which we and our clients have invested in.
Okay, so that's Manappuram and Muthoot. What about some of the banks? Dipan, I mean, since you're invested in the space, I'm sure you're looking at things very, very carefully. Some of the regional banks as well, whether it's CSB or maybe South Indian Bank, even Canara, I mean, they're all trying to expand their gold loan business in a big way. Do you see the change in LTV norms having any material impact? I mean, is there any reason to look at any of the South India-based banks?
So they're all very attractively valued. But, when you want to buy a gold loan business because of the relaxation which they have got, just go with the market leader because with the other banks, they've got other issues as well or other businesses which may not grow as fast. And, Muthoot Finance, especially in Manappuram, and secondly, so Muthoot Finance's risk management has been pretty decent. Their provisioning has never been completely out of hand. And the gold loan business per se is quite safe. So I would still go with, if I want to play this particular investment strategy of gold loan, I would still play with Muthoot Finance. Although if you're invested in CSB or South Indian Bank, I would remain invested. I think there's scope for P re-rating over there as well. But let's see how the other businesses evolve. But
Oops, we'll connect with Dipan. But in the meanwhile, let's put the spotlight on the broader NBFC basket. Brokerages have been putting out their views post the RBI policy action. You're seeing a follow-up rally today in many of the names. Sudarshan joins in with the brokerage view. Sudarshan?
So we have seen today Nifty Bank hitting record high, led by continued gains that both banks and NBFCs have seen. And all the brokerages have written post RBI policy, and they have tried to figure out which all banks or NBFCs will be biggest beneficiaries of the announcements made by RBI on Friday. So first, Nomura says CRR cut is going to be higher for mid-sized banks like IndusInd Bank, AU Small Finance Bank and Federal Bank. Also, it will benefit deposit growth constrained large banks like Axis Bank and HDFC Bank. As for Goldman Sachs, beneficiaries of RBI policy are going to be majorly in the banking space, Axis Bank and HDFC Bank. Also, for NBFCs with higher proportion having fixed rate assets, and those companies are SBI Card, Shriram Finance and Chola Finance. Also better mix of fixed versus floating rate assets and liabilities those companies have, and those are AU Small Finance Bank, IndusInd Bank and IDFC First Bank. Bernstein says announcements made by RBI will be majorly positive for banks than NBFCs. Citi says it's positive for banks where deposit growth is closely monitored, and those companies are HDFC Bank and Axis Bank. Also, liquidity easing via CRR and sustainable liquidity could improve credit flow into NBFCs, and that may help companies like Shriram Finance. UBS says banks requiring greater liquidity will benefit, and those are AU Small Finance Bank, HDFC Bank and Axis Bank. Also on NBFCs, UBS says sustained decline in PSU bond yields could lead to additional 10 bips benefit in cost of funds for companies like PFC and REC in FY26. Also NBFCs with higher share of bank borrowings to benefit more, and here those companies are Chola Finance and M&M Finance. Today, Bandhan Bank is in focus and stock is up almost 7%. On Friday, after RBI policy announcements, RBI Deputy Governor had said that there is no specific regulatory measures for MFI. Also, as per RBI, MFI business should stabilize over next few quarters.
Yeah, absolutely. I mean, I do remember hearing that in the press conference, and that seems to have had a good drop-off effect on Bandhan. Thank you very much for that comprehensive wrap, Sud. Well, we did catch up with one of the analysts. We were in conversation with Pranav Gundapalle of Bernstein, who shared his view and explained why he would rather be happy owning the larger private sector banks versus some of the NBFCs at this point.
If you look at the expectations, I think the EPS growth expectations are well over 20%, 20-25%, which assumes rate cuts and the rate cuts leading to growth and some more as well. So with valuations also in the picture, we'll probably still prefer the large private sector banks, the likes of HDFC, Axis, etc., have seen their growth slow down because of tight liquidity conditions. With liquidity easing, we think they'll see a bit of a relief and could drive better numbers and hopefully some re-rating as well. So absolute operating benefits will be NBFCs, but once you throw valuation in, it'll probably be the larger private sector banks. Gold lenders, we do like Muthoot. I think they've just come back to where they were prior to all the regulatory noise. So in terms of valuation, I think it still has some legs to run.
Muthoot is clearly the winner identified by the markets. You know, in April, when the draft norms came up and the stocks were rattled, the stock price of Muthoot Finance fell from 2,300. It went down to 2,000, and now Muthoot Finance is back above 2,500. Dipan is back with us. Dipan, given the CD ratio, would you back some of these larger private banks like an Axis Bank, HDFC Bank, which have been identified as winners by the brokerages?
See, Rima, first of all, no, when I look at many portfolios, no, almost everybody is overweight banks. So investors who are underweight banks, my advice would be to go for the PSU banks or the weaker private sector banks, because in such an environment like this, which is almost like blue sky, you're better off with weaker banks. They'll give you the better, the alpha will be better over there, the change in profit will be better, and there's scope for P getting re-rated. So that would be my strategy as far as banks and NBFCs are concerned, that in a situation like this, it's not a good strategy to buy the best bank, but to buy the best investment. The best investment could be a weak bank, which is just about turning around.
Okay, and then those provide opportunities, right? I mean, so just a quick word, if you will, Deepan. I don't know if you have a view on Bandhan Bank. All right, it's, I think, if there's one kind of stock which epitomizes what you said, turning, but not yet. But maybe it'll. I remember the last conversation we had with the MD after the earnings, and they said things will start to turn Q3 because they've taken all the pain now. They've recognized everything. On Friday, I think Jefferies, I don't know if Sudarshan mentioned it, but Jefferies has added Bandhan to their conviction call list, their banking analysts. I don't know if you have a view here, Deepan.
Yeah, I think it fits perfectly in our strategy going for turnaround banks. And the worst seems to be over for Bandhan. Fewer surprises in the last couple of quarters or so. Valuation comfort is there. It's a large bank, and it's transitioned from a microfinance to a larger bank with many products. That is going on smoothly. They've been having setbacks, but I think the last microfinance crisis, which hit Spandana Spurti and some of the other microfinancers, I think Bandhan Bank was less impacted because of whatever lessons they have learned in the past. So I would say that, yes, that's one stock, which can outperform the banking index also over the next few months or quarters, given the kind of low interest rate scenario and higher liquidity which is there, because that certainly will help the banks and NBFCs.
Let's talk about the life insurance industry data, which has been released for the month of May. Yash joins in with the details. Yash.
Well, in the last few months, the data has not been very positive, but the month of May brings a very pleasant and a positive change as far as the industry growth is concerned. The industry has grown at a strong pace, the total industry as well as the private life insurance industry, and the two, strong support as far as this particular growth is concerned have turned out to be HDFC Life and Max Financial or Axis Max Life Insurance. For Axis Max Life Insurance, in the month of May, the premiums grown by about 26%, total APE growing by 28%, retail APE by 25%. This strong growth has come on a strong base which it had to grow on. So that's another positive. Same for HDFC Life, a strong growth in the month of May over a strong base which it had in the form of May 2024. So May premium for HDFC Life growing at 33%, total APE growing at 19%, retail APE growing at 15%. For ICICI Prudential Life Insurance, it's a weak growth, but the company had a strong base to grow on. So as far as May premium is concerned, that's grown by about 7%, total APE by 1%, retail APE, that has seen a contraction of 14%. SBI Life Insurance, it's weak growth again on a mixed base which the company had. So May premium growing by 25%, total APE growing by 13%, retail APE growing by about 4%. Finally, LIC, it's a strong growth for LIC on a mixed base. So May premium, that is grown by 11%, total APE by 21%, retail APE that is contracted by 7%. This largely shows that for LIC, the individual business would not have performed very well, but the group business has seen a very strong growth, and hence the 21% growth as far as the total APE is concerned.
Okay, all right. Thanks a lot for that, Yash. Shubhal, let's hop across to Deepan. Deepan, on the insurance pack, actually, if I take a look at the last 24 months or so, this pack has underperformed. How do you read these data points that Yash brought to us? And from the pack, where is, which is your preferred stock?
No, I think I'm getting a bit underweight as far as insurance companies are concerned. And first of all, it's a very complicated industry to understand and even more complicated to value. And you put in all the effort, but at the end of the day, the growth is not that significant. I mean, in terms of returns. I mean, if you look at HDFC Life, last 5 year returns have been around 8.5% or so. So the best insurance company has hardly delivered growth in terms of returns. Then just speak about the sector. My understanding is that it is heavily regulated, very little scope for innovation, highly competitive. And there are so many other ways to play this financialization of savings. So if you have a particular allocation for that particular investment theme, which is financialization, I would say there are better choices than the insurance companies.
Okay. All right. I lost my mic.
All right. All right, Deepan, thank you very much for that. And this is a note for all our viewers. We are unlocking a new dimension of business intelligence with CNBC TV18 Access. For our Prime members only, you can experience CNBC-TV18.com from market-moving insights and thought leadership to exclusive access to marquee events, journalist interaction, studio tours, high-impact learning sessions. So this is truly an elevated experience with members also enjoying curated lifestyle privileges and perks of the power of insight, the privilege of access, exclusivity, experiences, and influence. Yours to claim. Become a member. Log on to cnbctv18.com/access/plans.
Welcome back. Well, let's now get to some proprietary CNBC-TV18 research, and we've got Nimesh joining. You know, we've all noticed that in the last 1 or 2 weeks, railway stocks have really started rising higher. Your Ircon, RailTel, RVNL, all the stocks are up and about. Is there any trigger? Perhaps not. But the bigger question is that are earnings of these stocks able to catch up or at least keep pace with the way the stock prices are rising? Nimesh, you tell us. You've done the number crunching. What is the data throwing up?
Well, Surbi, the data will surprise you and surprise you on the negative side. First, on the move in the stock prices. Last 1 month, most of the railway stocks have been buzzing, are up between 21 to almost 40-45%. IRFC is up 21, Ircon is up 38%, RailTel is up 47%, RITES and RBNL 36 and 24. Having said that, they're still at least far off from their recent highs. From the recent highs, they're still down 30 to 40%. So they've not reached the previous peak, but they've rallied in the last 1 month. Having said that, look at the valuation picture. The second plate will come up as to where they stand in terms of valuations now. Ircon is trading at 28 times 1 year forward versus the 5-year average of just 15 times. RailTel is now at 47 times. RITES is trading at 34 times versus 5-year average of 21 times. And RVNL, the new entrant into FNO, now it's trading at 60 times versus their 5-year average of 12 times. So that's the valuation picture. The next table will come as a bit of a shocker for a lot of viewers, and that's what I wanted to highlight, is whether earnings are catching up or they're delivering on numbers. The answer to that is largely no. Look at this is a 2-year sales, PAT and EBITDA CAGR for all these railway companies. I'll start with IRFC first. I'll start with Ircon first. Look at the sales CAGR, just 2% sales CAGR in 2 years, negative profit growth. That means a loss, and EBITDA growth of less than 10%. Second stock is IRFC. Just again, 3% sales CAGR, 2% profit CAGR, and no EBITDA. RVNL has actually reported a degrowth in the last 2 years across all parameters, whether it's sale, profit, or for that matter, EBITDA as well. RailTel, again, that's the only company in that railway space which has done reasonably well. They've done a sales CAGR of 33% in last 2 years, a profit CAGR of nearly 30%, and EBITDA CAGR of 17%. Even RITES has actually reported a negative growth in last 2 years across all parameters. So, as I said, while stocks have been buzzing, the valuations are quite stiff and expensive. It's not backed by numbers in most of the railway companies, barring, as I said, barring RailTel. All others have reported a very small single-digit growth or, in fact, negative growth in the last 2 years. So, the only consistent, Surbi, in all the railway names, if you put out the last plate, is the retail ownership going up. Across all the 5 names in the last 1 year, the retail participation has gone up from in IRFC from 44 lakhs of retail ownership, that's gone to 56 lakh. Same with RVNL, 18 to 24. For RailTel, from 3.5 lakhs to almost 5.5 lakhs. So is with Ircon and RITES. The retail participation, the retail ownership has only gone up. So it's largely a retail, frenzy for railway stocks. But do remember, in many of these companies, it's not backed by very strong, for that matter, there has been a degrowth in many railway companies in the last 2 years.
Okay, all right, got that. Thanks very much, Nimesh, for that interesting, analysis there. So, need to see if the fundamentals and indeed if the earnings can keep pace with the stock prices, which have been running away. Well, let's discuss this and, of course, a lot more with Ajay Tyagi, our next guest on the show. He's head of equity at UTI Asset Management. Ajay, great to have you with us. Good afternoon to you. So, let's start right there. PSUs were the poster child of the poster boys and girls of the rally up until we hit the peak in September last year. But at least some of these PSU pockets, defense, for instance, there's still a lot of interest. Railway, like my colleague Nimesh was saying, still a lot of interest. How are you positioned overall on PSUs in your portfolios? And within that, specifically defense and railways, what's the advice?
Yeah, I can't be too stock specific, but, just to give you the broad thought process, see, rather than getting sucked in by narratives or, certain part of the market, perhaps just because that part of the market is undergoing some very positive momentum or a strong momentum, we always try and evaluate businesses from a 3 to 5 year perspective. Whether they are a PSU or they are not a PSU, if the business prospects remain strong from a medium to long-term perspective, we always get excited about these opportunities. And when I say prospects look good, we should be able to witness this in hard numbers in terms of profitability, sustainability of margins, generation of cash flows, and so on. Having said that, out of the list of industries that you just spelled out, there are a few companies in the defense sector which we think have a fairly strong business model going into the medium to long term. And yeah, I mean, possibly that's the reason why we would be keenly evaluating them. Yeah.
Got that. Mr. Tyagi, hi, afternoon. This is Rima here. You're also getting constructive on the consumer discretionary sector and even consumer durables at this juncture. Now, if you remember post-budget, on the back of the government stimulus, there was so much optimism. Stocks did well, but the rally faded. Do you think this time it's going to be different and it could be a structural up move in consumer durables and discretionary?
Well, that's our base case right now. We think that over the last few years, the consumer demand has been very weak. And see, like any other industry, even the consumer demand is fairly cyclical. I mean, it remains strong at a point of time, but then weakens, forms a trough, and from there it starts to strengthen once again. So if you look at these patterns, number one, we are tempted to believe that after a very poor last couple of years, because of a variety of reasons, of course, disposable income was under stress, inflation was high, and so on. From that trough, we see consumer demand picking up. That's point number one. Point number two is that, of course, the government, one way or the other, is putting money in the pockets of consumers at large. Now, income tax cuts were obviously one way of, putting more money in the pockets. But we've also seen various state governments also roll out certain welfare schemes. So at the aggregate level, this does add up to a meaningful amount, which can help, perk up this consumer demand, which has been weak. Last but not the least, falling interest rates certainly are a positive for the discretionary end of the consumer demand. So all of these factors put together, to our mind, only bolster the case for better days for consumer-related sectors in the coming years. Yeah.
Okay, so consumer, you're saying could be something worth looking at. The other, of course, point of discussion today is financials. Last couple of days, actually, because of this easier monetary stance that we've seen from the RBI, rate cuts, CRR cuts, and many feel that maybe we'll still get another 25 bips. Maybe not in the next policy, maybe down the year. So in this environment, what do you like the most? And it's a vast universe. So private banks, PSU banks, NBFCs, give us some sense of how to play it.
Once again, I'll take you back to my reply to your first question. We are usually, rather than just bucketing them as private banks or PSU banks, we just, look under the hood in terms of what is the business looking like for each of these banks, whether, private or PSU? What has been their track record in terms of A, growth, and B, controlling credit costs? And see, this is very important because, in terms of banks, we are not only looking at growth, we are also looking at how their balance sheets would shape up, whether they will remain strong, or are there chances of accidents? What's the credit underwriting capability? What has been the track record, and so on? So, if you were to weigh in all these factors, we are tempted to look at private sector banks, more favorably. The other reason is, of course, their valuations still continue to be at or below their long-term averages. Do remember, we are talking about a market where valuations are at least 20 to 30% higher than long-term averages. And in this scenario, if there are institutions, if there are banks which are actually trading at or slightly below long-term averages, it just tells you how attractive they are purely on valuations. Of course, CRR cut is going to throw in huge amount of liquidity into the system, which is only going to benefit these banks over time. And we strongly feel that there is a case for credit growth in India remaining in double digits, in low teens numbers for a protracted period of time. Yeah.
What's the broader market call for the second half of the year? And you're also recommending a balanced advantage fund or a multi-asset allocation fund. Why is that?
This is purely from our view about the valuations at which the markets are trading right now. Like I mentioned, everything is expensive. Of course, we find the mid caps and the small caps to be significantly higher than what their valuations ought to be. So that's the part of the market which we are very cautious about. I would say even large caps are not trading cheap, but on a relative basis, they are better off than mid and small caps. So, we find valuations to be expensive in each and every corner of the market. And because of this view, we are advocating, hybrid funds like Balanced Advantage and multi-asset funds, because we feel that at this juncture, the most important thing is downside protection. Which brings me to the first part of your question, which is that our view is cautious on the markets. We feel that markets, which made a peak in September of last year, may continue to actually consolidate for some more time. Now, it's very difficult to, forecast these things, but our view basis valuations and also our view on earnings growth over the next couple of quarters brings us to this conclusion that we would see more of consolidation in the coming quarters. Yeah.
Okay, so you're expecting more consolidation. Ajay, since we've seen pockets, I mean, the mid caps have come back quite a bit throughout April, May. We've seen a big pullback in mid caps. Are there any pockets of the market where you see a bit of risk building up again? I mean, would you advise lightening positions anywhere?
See, I think the what we call as the high beta part of the market has once again started to move up, and it's moved up very sharply in the last almost 2 months. I mean, the rally started sometime towards the beginning of April, and it has been going on unabated. So the high beta part of the market is certainly looking overheated, and that's where we would be cautious. Now, this is across many different sectors, but I would say in general, the narrative stocks, as you call them, are the ones which we are most cautious about at this stage.
Cautious about narrative stocks, cautious about the markets also on the whole, and valuations of the small and mid caps are pretty high right now. Ajay, thank you very much for joining in. We'll get into a break on that note. On the other side, we'll get you a check on what dealing rooms are saying in our segment Day Street Chatter. We'll also get you a few BTST calls. Stay tuned.
What is your leadership language?
Maybe this sounds controversial, but the classic hierarchical organization is no longer going to be relevant.
How you came back to India in 2015, the height of the Maggie crisis.
My father later on told me, when I called him up, I said, "Dad, should I take up this?" So he said, "Son, nobody puts an idiot into a crisis." Most corporations, Shireen, and you know it better than I do because you see many more people, they seldom fail because of lousy strategies. They fail because of lousy leadership.
What is one of the most underrated management principles?
I think the word happy has vanished from our dictionary.
What have been the biggest lessons from a marketing point of view that you would like to leave?
Kodak did not fail because it was a lousy brand. We did a small experiment to have Maggie counters in weddings. A Maggie stall attracted far more attention than the other traditional food fare.
In a wedding?
In a wedding.
How difficult and how different is the Gen Z customer?
They don't come in with a reverence for any brand.
Why do you say so?
Welcome back. Well, markets continue to hold with gains of close to under 100 points, but the big story is really in the broader markets, and the mid-cap index continues to hold with a gain of around 1.1%. Nimesh is back with us, though, to give us a brief idea in terms of flows. Nimesh, what are you picking up?
Hi, Nigel. A good day, but again, I guess market will be a bit disappointed that there was no follow-up buying either in Nifty or in the Nifty Bank as well. Having said that, there is buying in the financial names, especially the private bank names, the small private bank stocks, so to speak, in today's market. And if you look at most of the brokerage notes, everybody seems to be consensus on that the small private banks could be big beneficiaries on the RBI move. So that's clearly playing out. In fact, there is a bit of profit booking in the NBFCs today. So that's overall feedback as well, that after the big up move, a bit of profit booking in the NBFC basket today. The broader markets continue to outperform. Big moves in that space. The mid-cap index is up another 1.5%. And clearly there is momentum now which is chasing the broader market stocks, whether it's from retail HNI investors or for that matter from the funds as well. I guess, the trend of large blocks, fundraising, that's likely to continue in the days to come. So that apart, I guess I would say it's a relatively disappointing day that despite such a big bazooka from the RBI, we haven't seen very large FI or follow-up buying in the Nifty and the financial names.
Okay, all right, Nimesh, got that. What about individual stocks? What are you picking up?
So in terms of individual names, the first target on my list is Capri Global. Big move in that name is up 16-17%. Last I checked, the volumes also picked up. And I understand the company is very close to raising funds via QIP. In fact, some large domestic funds and a couple of HNIs are likely to invest in the Capri Global QIP. So that's the reason why that stock is buzzing in trade today. The second, a couple of names where there is delivery-based buying, Chola Invest as well as HDFC AMC. So expect high delivery-based volumes on both these names on the back of FI buying. So that's the second group of stocks. The third name is Greenlam Industries. Even that is buzzing in trade of 5% after a block. Nearly 10 lakh shares got changed hands. Understand few domestic mutual funds were seller and a large influential HNI investor has been buying of late into Greenlam. And the last one is Jain Irrigation. Even that's buzzing in trade today, but for Jain Irrigation, there is a strong indication of a large block coming in Jain Irrigation very soon. I understand some domestic banks hold a chunk and they could be cleaning out. So a bit of interesting deal to track in Jain Irrigation, but there could be a large block deal very soon.
Got that. Thank you very much for that. The stock is already up close to about 3.5%. Mitesh is now back with us for a few BTST calls. Mitesh, what do you have for us?
So, I would recommend the BTST on Indus Towers. Keep a stop below levels of 393. Look for a target of around 400 over here to begin with. And then maybe, if all goes well, we might even look at higher levels. The other stock which I like is IRB Infra. Keep a stop below 52.85 for targets of around 53.70.
Got that. Thank you very much for that. Mayuresh Joshi is joining in for the last leg of the market. The Nifty is holding on to 25,100. So we have seen some follow-on rally, but we've not managed to hold on to the day's high, which was 25,160. Mid and small caps, though, are doing exceedingly well with a rally of more than 1% and a strong advanced decline ratio to start the week with. Mayuresh is with us. Mayuresh, the top loser on the Nifty is Eternal. Swiggy is also corrected, and this is following Rapido's entry into the food delivery market. Competition rises when there is money to be made, when the pie is large and there is opportunity. But, anyway, they were facing competition in quick commerce, and now you've got competition even in food delivery, and any new player always adopts the discounting route. How do you see this place evolve?
Afternoon, Ruma. No, I think absolutely logical. So I think any new entrant which is expected to come in will use discounting as a tactic to probably ensure that he starts garnering some element of market share. And therefore, I think the kind of strategy that Rapido has adopted is not a surprise because they do want to get some foothold into the quick commerce market. Having said that, I think all the elements that Eternal and Swiggy are going through at this juncture, both in terms of the accelerated capex that both these companies are undergoing at this juncture to ensure that the dark stores double within the next 3 to 4 quarters. And the strategy that has been well defined. Earlier, I think the expectation was that this should expand over 2 years. They do want to expand this over 1 year because they do sense that competition is brewing up. And it's not just from Rapido. I think you've got players like a JioMart as an example, who are also running pilots. You've got players like an Amazon, who are running pilots as well. and also select niche players, e-commerce players, who are probably trying to establish some element of platforms of their own as far as the delivery systems are concerned. Having said that, I think the expectations in terms of numbers being muted for the next 2 to 3 quarters, to say the least, is something that the street comprehends as we go along. But the bigger picture argument here is what after those 2 or 3 quarters? Do they make a strong comeback with the kind of infrastructure and the dark stores that they would have built across the length and breadth of the country, which gives them the added advantage compared to competitors as well? And that is what I think the markets are probably trying to, let's say, and probably give that element of a risk premium, even if numbers probably come on the softer side. So yeah, I think the price strength has been reasonable for return from lower levels. Swiggy has also seen a decent bounce back. The expectation, as I said, is that post 2 or 3 quarters, they might start regaining the market share because of the dynamics that they're playing.
Okay. Got that. Mayuresh, good to have you on the show. Financials. I mean, the rally simply continues. So let me just ask you for your top picks. I mean, everything's moving higher. Geo Finance, by the way, has been finding increasing traction as well. There have been steady gains throughout the last 2-3 weeks. What's your, let's just get your top 3 or 4 financial picks in this environment.
Afternoon, Surabhi. So I think if I need to break down financials between banks, the private sector banks, the public sector banks, and the NBFCs, within private sector banks, our top pick still remains ICICI Bank. Our own sense is that the expectations that one really builds in and pencils in terms of strong advances growth for the franchise itself, I think that should continue very, very strongly. Obviously, I think the credit underwriting is something to be watched out for. Liquidity is going to be abundant in the system, and therefore I think the expectation in terms of asset quality pressures building up onto the balance is something to watch for as well. However, in our opinion, I think ICICI Bank should probably pass through most of these litmus tests, whether it comes to advances growth, reasonable amount of deposit accumulation as well. Asset deterioration largely behind us. NIM should be stable. Provisioning is strong, and the capital adequacy remains strong. And therefore, I think the risk-weighted assets, including expectations of stronger return ratios, should probably persist for ICICI Bank. The big sector universe, leaving aside State Bank from the market names, one sense is that Bank of Baroda, Bank of Maharashtra, both can be kept on your radar. And again, I think the similar arguments put forth for ICICI Bank. The only 2 additional aspects that come through are the expectations in terms of stronger treasury incomes actually also getting played out on PSU balance sheets as we speak. And the write-offs. I think as there is a stronger recovery in terms of the write-offs that have probably happened, a lot of PSU banks have adhered to this fact. I think these 2 become additional points in terms of how earnings might actually stack up, and therefore significant improvement in ROAs specifically as we see. So Bank of Baroda and Bank of Maharashtra is something that we've got on the global watch lists as well. Within the NBFC, I think Shriram Finance is something that we continue holding on our local and global portfolios. Our sense is that the kind of diversification that Shriram Finance has, both in terms of its advance book, the expectations of its borrowing mix, the expectations of an interest rate cut, which has largely happened, a 25 bips cut expected to happen, will give it a diversified sense in terms of ensuring that the NIMs and spreads are probably well maintained as we head into the next few quarters. And obviously, I think from a book perspective, if you look at the unsecured gold loan personal loan portfolio, that's capped at 4.5%, which gives them the additional advantage in terms of asset quality pressures not deteriorating in an environment where advances are going to probably be something that the street probably watches out for, specifically when it comes to the NBFC universe. So I think these 3-4 stocks are something that we continue holding in a global and local.
Okay, all right. Hi, Mayuresh. Good afternoon. Good to see you in Aditya Birla Real Estate. The stock is up close to 4%. They've secured some investments in a couple of their projects. And I think MK was one brokerage I recall that was quite positive on the stock. I recall it correcting on very low volumes when the markets went into a bit of a tizzy. But it's bounced back in style. If I pull up the last 15-day chart, I think the stock is up 15%. What's your view on this name?
So I think generally, Nigel, afternoon to you as well. I think generally for the real estate space, I think we need to be a little bit more selective at this juncture. Obviously, I think the land bank that they possess is significant. And therefore, I think the entire onus in terms of the real estate sector as a whole is going to be how are they going to monetize all the projects that they're probably doing? How is the pre-sales velocity expected to take place? And therefore, what is the cash flows that probably come through over the next 3 to 4 quarters? Having said that, I think what we really kept on our watch list is Prestige Estates at this juncture, because they've got a right mix in terms of residential, commercial, as well as the retail portfolio. The expectation in terms of what the management probably believes, the projects that are ongoing at this juncture are significant as we speak, almost 115 million square feet of development. Ongoing projects or the upcoming projects might be 88 million square feet of development that will come through. They've got a good mix as far as residential is concerned. And in fact, their Mumbai property launch that they've probably done, Nautilus, has actually exceeded pre-sales velocity. And therefore, I think key markets, including Bangalore, Mumbai, Hyderabad, expected to do well. On the commercial stroke annuity part of the business, expectations in terms of fit outs and renegotiations are expected to happen at a significant scale as we head into the next few quarters. And on the retail side as well, I think significant additions that are expected. On the cash flow argument that I was just saying, I think if you look at the upcoming and the ongoing projects that are expected to come through, they've got massive cash flows that can probably come through over the next few quarters. So I think out of the real estate outside, again, DLF and Godrej, I think Prestige is something that we've kept on.
Okay, so Prestige on your radar on the buy side as well. Got that, Mayuresh. Just stay on. We'll have more questions for you in just a bit, but we're looking at a story that's coming in from our Delhi colleagues now. We understand from sources that the centre could be looking at a higher than budgeted CPSE dividend in FY26. Sapna is here with more details. Sapna, what exactly are you picking up?
Well, it's again likely that the dividends garnered from the central public sector undertakings by the government, that's going to beat the budget estimate once again. That's what the expectation is. The government is definitely eyeing at least around 80,000 odd crores as CPSE dividends. Now, this is 16% higher than the budget estimate of around 69 odd thousand crores. So, that's significantly higher. But having said that, if you compare this with what has happened in the previous year was almost like a bull run as far as CPSE dividends are concerned. The dividend payout to government was higher by almost 35% in comparison to the budget. Plus, also if you look at this 80 odd thousand crore number in comparison to the actuals of last year. So last year the actuals were around 74 odd thousand crores. So as compared to that, it's only an 8% growth. But having said that, we also need to keep in mind that 30% of the PAT of companies or 4% of net worth, whichever is higher, goes as dividends. So basically, if the company balance sheets are doing well and good profits are coming in, well, so this 80 odd thousand crore number could also be conservative as far as the government is concerned. But as of now, it appears that the pace of growth in the CPSE dividends down the line is likely to come down. Though, of course, the number would be larger, or rather what the government gets would be larger than what they have budgeted.
Thank you very much for that, Sapna. That's an important story that we'll be tracking. We'll slip into a break on that note. About a few minutes left to close the markets. The Nifty is exactly up, at the 25,100 mark with a gain of 100 points. Welcome back. Some of the railway stocks are a tad bit subdued. So look at IRCON. Nimesh was earlier highlighting how many of these railway companies, the profit growth, the revenue growth, CAGR growth has been very subpar, and yet the retail holding in these names has only been rising and stocks continue to rocket. But today it's taken a bit of a backseat. Mayuresh, have you been recommending any railway stock to your clients, or has it been an avoid?
No, not really, Rima. And again, I think the argument, as you rightly pointed out, is that there is no consistency in terms of earnings growth that is probably coming through. And it's remaining very, very patchy over the last few quarters. Again, I think the expectations in terms of government spending when it comes to railway infrastructure, and again, I think a very composite kind of holistic picture of that, whether it's railway lines, creating infrastructure developments at railway stations, anti-collision system, metro coaches, etc. I think that's not still reflecting in consistency that one really looks at in terms of price performance and earnings performance. And therefore, I think a few of the stocks do have momentum tailwinds behind them. Stocks like RailTel, RVNL. Something that we like to keep on our radar and watch out in terms of quarterly numbers will be Tex Macro Rail. We might think this is one interesting story, in our opinion, where there has been a stark turnaround a couple of years back, but whether they're able to probably achieve much more and deliver much more is something to be seen. So I think we're just keeping on our radar to have an earnings perspective taken.
Okay, got that. Mayuresh, by the way, we were discussing this move in the burger stock today, burger mania going on Westlife. I'm not sure if you heard anything new in the market, or if it's just some excitement, because we know that QSR stocks have not done much. There have been small bursts of activity, but they've been kind of off the radar for a long time. Any interest here?
Not now. I think we'll wait for definite signs, Surabhi, for some earnings pickup to show up. And we don't mind if we lose a 5 or even a 10% move in these stocks. But unless we get complete clarity that there is some element of definite turnaround in terms of consumption patterns coming back, which probably seems to be a base case scenario with tax cuts, with better monsoons, the asset-light model that most of these franchisees are adopting in tier 2, tier 3 cities. I think then it probably makes a base case that earnings might start improving a few quarters down the line. But as of now, I think, again, the earnings still remain very, very patchy and subdued as we speak.
Yeah, all right. Mayuresh, what about asset management companies? What do you prefer out there? HDFC, AMC, that suddenly spiked up. You had Nippon AMC. In the last few months, it's steadily been moving up. And the markets were in a tizzy. It corrected sharply, but it's pulled back in style if you pull up a last 3-month chart. What do you like from this space?
Nigel, HDFC AMC is something that we kept on our radar, and therefore I think we continue holding this in our global portfolios. Our sense is that it's got an appropriate mix as far as the equity and the debt AUM is concerned. A large portion in terms of the issues that the asset management industry was going through, both in terms of fees and some element of regulatory concerns, are largely behind us. And therefore, with the expectations of tailwinds for market penetration, with the expectations of more investors coming in over the next few years, I think the kind of operating leverage that asset management companies can probably derive can be quite substantial. So I think within the AMC pack, I think HDFC AMC remains part of it.
Okay. All right, Mayuresh, got that. Thanks very much. Just give us a couple of minutes. We'll wrap up today's trading action. Then we come back to you for more ideas. So it's been a positive day. There's no doubt about that. Positive consolidation, taking steps higher and right at the top of the 3-week trading range. That's the Nifty for you, with a gain of about 100 points. Of course, it was eclipsed by the Midcap index, because the Midcap index has gained far more, over 1% up on the Midcap index, but a solid day nonetheless. And of course, the leadership came in from financials everywhere, whether it's large cap financials, mid-cap financials, banks, NBFCs, power financiers, brokers, you name it. It was really up in a way. So let's look at the names from the Nifty. Jio Finance has had a great session today, 4% higher. Kotak Mahindra Bank, 3% up. Bajaj Finance, 2.5%. There's Axis Bank with a gain of about 2% as well. Many of the names on the upside. Shriram Finance, about 1.2%. Tech was the other pack that actually helped the bulls' cause today. Wipro, TCS, for instance, they're all going home with gains of about 1% or so. We also had some contribution in the form of L&T, ITC, some of the index heavyweights also chipping in. Reliance did its part, just about 0.25% up. Not a big day for Reliance, but nonetheless, it counted on the positive side. On the flip side, the only financial stock that stands out with the very clear selling today is actually ICICI Bank. It's ending at the lows of the day with a cut of almost 2%. So watch for this one. And then, of course, Eternal on the index is the weakest name on the Nifty because of now the threat of new competition coming in. Eternal was down 2%. So was Swiggy, actually. Swiggy falling a little over 2%.
Well, on the mid-cap end of trade, it was all about PSU banks, capital market plays and NBFCs. So to run you through some of the big movers on the way up on large volumes, JM Financial comes up, Edelweiss Financial, Bandhan Bank also up nearly about 7%, RBL Bank, IREDA, South Indian Bank, Bank of India, IEX and MCX also big movers today. IEX ending with gains of close to about 4%. So dominating the green ticker. On the way down, you had softness in names like an Ircon. We were discussing that. That's down close to about 0.5%. So, yeah, but on the whole, the mid-cap index closing very smartly, solid 1% up. Follow-on rally seen for the mid and the small-cap index. It's a wrap and closing bell. Don't go anywhere. Markets Forward comes up next.